Um, welcome to this webinar. This is part of Ethical Consumer Week. And what we're going to be doing today is talking about what people can do to align their money with their climate values. My name's Josh Brewer. I'm the Senior Business Development Manager at Ethics. We're a positive investing platform. We also have a sister platform called Energise Africa. I'm joined by an absolutely fantastic panel today. I've got Francesca Spurry from the Values Aligned Finance. Hi, Francesca. I've got Josh Gregory from Sugi. Hi, Josh. And I've got Julian Parrott from Ethical Futures. Hi, Julian. And today we're going to be discussing the sort of range of options that are open to individuals who want to start using their finance to tackle climate change, accelerate the sustainable development goals, or just generally create a positive social impact through their investing. The idea is it's sort of straightforward, practical, useful for attendees to help them understand the power that their money has in supporting action on climate change, and what options they need to be aware of, and how to get started, really. So just before we get going, I'll do a bit of housekeeping. So it's important to say this is not a financial promotion. It's about sharing general information. We can't answer any specific questions on individual circumstances. Please post any questions you might have into the chat. We'll try and work them into the conversation. I'll cover them at the end. If we don't get to all of them, we'll try and follow up with answers as well. Today's webinar is being recorded. There'll be an opportunity to rewatch it on the Ethics website or on the YouTube channel. There'll also be a follow-up email with links to any of the resources that we might discuss today. In total, I think we'll be around about 45 minutes, so we'll be finishing at 11:45. Okay, well, let's get started. So I think this can be quite a daunting area for people whenever they think about how they can use their money to have more impact. Someone once told me that people are more likely to get divorced and change their bank account. But there are financial products that people can have, that many people have, such as a current account or a pension, where that start can be made quite easily. And we're going to look into some of those today with our excellent panel. So what I'm going to do is I'm going to start off and I'm going to let that panel introduce themselves and the organisations they work for. And so if I just start with you, Francesca.
Yeah, thanks so much. It's a pleasure to be here. And I'm really excited about the discussion today. So my name is Francesca. I'm the founder of Values Aligned Finance, which is an organisation I actually set up only a few months ago. And it was really in response to initially my friends and people I know asking me what they could be doing to align their finances with their values. I had a call from a friend who wanted me to come into her organisation and talk to her colleagues about it. So I did that. I found it really interesting and there's lots of engagement. People were really passionate about this topic, which actually really surprised me. And I since then have been doing workshops for other corporates as well. And I cover really what people can do with their banks. So I love that stat, Josh, about people being more likely to get divorced than change their bank. I mean, it's true, switching rates in the UK are really low, probably the lowest of any European country, but there's a lot that we can do even with our current bank providers. So I talk about that. I go through pensions, how people can figure out what their pensions are doing on the impact side, savings, and then investments. So if people are investing, what are the platforms out there and what are the ways of investing that are most ethical or sustainable? And today I think we'll focus mostly on the green side, but I also look at social issues as well. There are less products out there, but it's still really interesting. So people's values range in lots of different things, and there are some ways of reflecting that, although the green and the environmental stuff is a little bit more advanced. Yeah,
I think. Thanks, Francesca. I totally agree with that. The S in ES and G often gets missed out, doesn't it? And it's kind of fundamentally linked actually to the E in many ways. So good to be speaking to that. Josh, if I could go over to you, please.
Sure. So thanks for inviting me. I'm Josh Gregory. I'm CEO of Sugi, which is a platform to help people understand the climate impact of their investments. And we're an app, we're live in the App Store. We show personalized carbon footprint as well as how hot your investments are. So 1.5, 2, 3 degrees, etc. And also some context in the form of benchmarks and comparison investments with a smaller footprint. We've got pretty comprehensive coverage of the UK investment market, and we automatically connect to all the major investment platforms. So yeah.
Right. Yeah, thanks, Josh. And I think this is it's crucial that there are these sort of tools out there that people could that are quite easy for people to just pick up and start using. And so I think Sugi helps do that. Julian, can I go to you, please?
So my name is Julian Parrott. I'm a partner in Ethical Futures. We're independent financial advisors and planners based up in Edinburgh, and we've been going for, well, I've been working in the sector for nigh on 20 years now in terms of financial advice. I used to be a mainstream financial advisor somewhere around about the millennium. I sort of really decided that I needed to kind of work in an area where because I was concerned about what my money did as well as how much it did in terms of making money. So sort of created the business Ethical Futures to help people align their values, with their money. So as we say, our objective is to kind of make your money change your world. We're very much sort of planning led. So we're about working predominantly with individuals from all walks of life to help them achieve their own personal financial aims and objectives, working out how much they need to achieve those goals, and then how to do it in a way that aligns values. And likewise, I actually, my personal values always came from a social perspective, but over the years I've really learned how the environment is a social issue in many ways, and happy to unpack that and discuss that in future. So yeah, we've been doing a long time. I do a few bit of other pieces of advice around the place, and I'm happy to come and share what I've gathered over those 20 years and with everybody here.
Thanks, Julian. Yeah, I mean, it's interesting you've had that kind of background in the sector. So in a previous job, I worked in an ESG ratings organization, and I think it's useful to kind of like frame where we were and where we've got to now in terms of green finance. And so in 2006, when we tried to talk to city-based asset managers, they were not remotely interested in what we had to say about investing in a positive way or in an ethical way. And then it changed, and they suddenly came to us and they said, yeah, we're really interested in what you're doing. And it was not because they suddenly woke up one morning and think, actually, we need to make the world a better place. It was because their clients and their customers and the pension funds said to them, actually, we care about this. And I think that's really important in that, it's driven by people wanting to make that change and making that demand and holding those organizations to account that manage their money. And I think, given the huge challenges we have around climate change, pollution, social impact of business, it means that we now have a lot of options that offer green or positive impact investment opportunities. And I suppose you've probably seen that, Julian, haven't you, as you've moved through the years as an IFA?
Oh, definitely. I mean, when I left mainstream advice after 10 years or so and set up, the business, I mean, people thought I was mad, to be perfectly honest. I mean, my peer group just couldn't work out how on earth I could make a living. And we only do values-based investment propositions, so it's not like we'll do a bit of mainstream if we need to, sort of thing. So and that's always been our policy. But courage of your convictions, and there were plenty of early adopters out there. So it's a bit funny to see the sudden sort of rush of interest in the sector after this kind of blue planet effect and such like in recent years. But you're right. It's about there is now a demand, and financial services is nothing if not slightly cynical in terms of responding to present company accepted, I hasten to add, but in terms of responding to an opportunity.
Yeah, thanks. So I suppose, it's probably worth just moving on and talking about, what options are open to people, and maybe we start with the most easiest ones for people to access. Francesca, would you like to just sort of talk a little bit about that?
Yeah, so I think, the easiest ones, I guess it depends on who you are and what your individual circumstance is. I just want to say I'm also not providing financial advice, so Julian's probably well placed for this, but I think that a lot of people have workplace pensions, and sometimes that could be an interesting way for people to start thinking about this. A lot of workplace pensions will have an ethical part, or sometimes it's called environmental, and there can be options in there for people. So the way that tends to work is that there's either pension pots that choose not to invest in certain sectors or certain organizations, and they're sort of divesting, or there's ones that are sort of engaging with those players. And I think anyone who's really thinking about their pension needs to think about whether they just don't want to be involved in those specific sectors that they think are sort of destroying the planet, for example, or if they want to be involved and with an organization that's helping them to change. So that's kind of like a very personal decision, and something that everyone can make sort of by themselves, but it's probably a good place to start. So are you happy to be invested in those companies that you think are causing damage, but someone's helping them to improve, or do you just not want to be associated with them at all? And so that's something that people often ask me about in my workshops that I run. And another place to start is also around current accounts. So banks, I mean, the banks is a little bit more difficult. It is hard. It's not hard to change your bank, but it's not like very exciting, and it's a bit of admin. And in the UK, we just don't do it at all. But there are ways of engaging your current bank, telling them what you care about. So how it works in the UK is we don't pay for our bank accounts, so our banks make money from the money that we put in, and then with that, they use that to invest in lots of different things. And there are lots of sustainable alternatives out there. But speaking to them and telling your bank that you care about this is actually having a really, really big impact as well. There are some places to start, but hopefully throughout this conversation, we'll talk about all of the other things that people can do.
Yeah, sure. And Julian, what's your sort of?
Yeah, I mean, Francesca's right. I mean, and your point earlier on about inertia being, I used to work in a building site, and I remember being told way back then that inertia was your best friend, because you didn't leave your branch. But yeah, we're not very good at it, but it's the obvious place to speak. Where do you have your bank, your cash money? Where does that sit? And the thing about making a values-based decision is, well, what is the organization that I'm doing with my money, and are there other places that I'd like to move to because they're more purposeful in terms of their objectives? So if you're with a mainstream high street bank, then there will be some that are wrapped up in a variety of things. I mean, there might be funding fossil fuel and such like through their lending activity. Some of them might be much more focused in terms of local areas, and small business and community. You might find that's perfectly acceptable. And it's it's not as hard as it was now. There's been legislation and requirement to require banks to talk to each other and actually transfer details. So it's just about making that decision to move something. Where you move to, I mean, there was an activity fairly recent, or in the last few years, about Make My Money Count, and that sort of started to have a campaign for moving money. If you're with a building society, and there's not that many real building societies out there these days, but they're mutually owned, and they have by law to lend on housing. So if you're happy with that, although you could argue that they still contribute to questionable housing booms, but if you're happy with that activity, then then that's perfectly neutral. There are other banks who are more purposeful in their objectives and their process, and you can search those out. that you can fund too. The pensions point as well is a great point. In the UK now, many people are in an occupational pension scheme through auto enrolment. So you get a job, you're automatically joined into pension. The regulations are designed to make that as simple as possible. So you have to do as little as possible. And I read a stat just recently that 95% of the people in a workplace pension are in what they call the default fund. That means you live, breathe, you work, you're on the payroll, you get put in a pension, you get put in the default fund. Generally, there will be a choice that has some values attached to it, but you have to make that choice. So you need to go into the website, which will generally be a website these days, to find out what the options are and click the button and switch your money. So these things are possible. And if you're in a final salary scheme, you can lobby your pension trustees. You can use statements of investment principles to engage with them. So it's all about being active.
Yeah, great. Thanks, Julian. Actually, we've had a question come in which says someone's leading a review of their pension scheme with a view to moving a new provider, and they want it to be as green and sustainable and ethical as possible. So what is there any advice from the panel, Francesca, maybe about how they could best go about that?
It's a great question. A few things to look out for. So generally, ethical, sustainable, I mean, all of those words don't really mean anything. So just to kind of like, when we're using them, I think when I use them, I think it's helpful just to kind of look beyond that. So that's just a word of caution for any of this work. But on the pension side, I think most of the kind of ethical, sustainable schemes will have some kind of industry that they don't invest in. And so that's kind of often the sort of base level. Then they might have a statement about what they kind of sectors they do invest in. For example, my workplace pension is Nest. They say they have a responsible approach to investing in biodiversity. So statements like that can be really helpful. Industry groups, so things around like advocacy groups that they're associated with. Are they wary of businesses that don't adhere by the UN Global Compact? There's like 5 or 6 different industry associations that some pension funds subscribe to. So they're also really useful to look out for. And then on the engagement side, of course, so are they engaging with the organizations that they're invested into? And that's a really important point. And they might say that. So for example, I think it's Pension Bee have a kind of pension fund that's kind of totally divested from certain sectors, and they have another one that engages, and they talk about their engagement approach. So I think they're the 4 things to look out for. So what's it deciding not to invest in? Are there any statements around what they are looking out for? Are they associated to industry groups or advocacy organizations that are doing that kind of thing? And then on the engagement side. So they're the 4 main things.
Okay, thanks. And then I suppose we think so we have those we have current accounts and pensions, which is the products that a lot of people have, but then there are other investment products out there as well. And I suppose when you start to broaden that out, one of the first areas you come to are funds. And as we've said, there's been an absolute explosion in the marketplace for green funds. And I suppose, Josh, over to you, and how is it just an ordinary investor able to look at that and make it differentiate between the ones that have a significant impact or those that have less of an impact?
It is quite difficult to cut through. As you said, there's been a huge explosion, especially in the last 12 to 18 months. And it is a bit of a Wild West, because lots of asset managers are basically rebranding their existing funds as ESG or sustainable. And there's really no regulation at the moment that can really address that problem. We know that there is some interest from the government in creating classification systems around this, but I think it's quite some way down the line. At Sugi, obviously, we have a specific way of looking at investments. So if you plug your portfolio into our app, you'll get to know at least the carbon impact and the global warming temperature alignment, which is just one way of looking at your investments, but quite important when you're looking from a climate sense. And also, you can really make a difference by looking at whether an investment is like an ETF or a fund. So I think we've been doing a lot of research into ETFs recently, and some of the new thematic ones that are coming out. And some of them are concentrating on things like climate solutions, on sustainable food, on some really interesting sustainable themes. And with those, you can be pretty sure that you're going to have an impact, because they're so selective in what types of investments they'll make. At the same time, they're quite limiting in terms of, you have to be really interested in that particular theme. So, and then you've got ESG versions of ETFs. So you've got like S&P 500 and then the S&P 500 ESG. Obviously, the ESG version is going to probably have a better impact, but again, it's not always the case. So I guess the answer is there's no easy solution.
Yeah. No, thank you. And this is one of those things you do have to, people do have to do your homework. You do have to go out there. You have to look at the resources, and you have to sort of dig behind the headlines and see what's actually sits underneath that, in terms of, as Francesca was saying, about actual commitments and policies on those investment funds. I suppose it's useful at this point to talk about there are other types of investments as well. So at Effect and Energise Africa, we enable people to make direct investments into impactful organisations. This is I mean, when you're thinking about your overall investment portfolio, this should only form a very, very small amount of that, probably no more than 10% of what you invest, because the risk profile is different. But it is a way of sort of investing so that you can put money directly into impactful organizations. There are a range of different products available as well. So people can invest into bonds. We do a lot of these through Energise Africa, quite short dated bonds. These can go into an innovative finance ISA, but there's also the opportunity to invest in community shares or ordinary shares as well. Julian, I don't know if you want to talk just a little bit more about sort of the broader options that are open to investors.
Yeah, certainly. But you know, I also wholeheartedly endorse what you say. I mean, I wouldn't be on this panel if I didn't believe in, you know, the work that ethics do and such like that. I think that what I find is that, and I've seen something in the chat about trust and what you can believe in and such like. You know, I was on a panel just recently about greenwashing, and I kind of have the view that greenwashing is in the eye of the beholder. So you, as Josh has been saying that, you know, there's been a plethora of investment funds that have come out and have tagged on terminology which suggests that they're you know, they're doing something worthy when they're not always. I mean, as a firm, we believe in the fact that we're trying to make money do something positive. We don't think that's achievable just by one stream or another. So it's not just your bank account. It's not just by doing a really purposeful and intentional investment that you would do through one of the offers through Energise Africa or FX, which are very strongly community or environmentally focused in an outcome. But also, you know, we need to engage with the wider world and work in the wider business sector as well. So we sort of try and kick the tires and look at that. I mean, now, whether it's a regular savings ISA, whether it's a personal pension scheme, whether it's a long-term investment for your future, something for a trust or a charity that you're involved in, there are investment funds and there are investment structures which can accommodate you know, a values-based proposition, something that will actually have some positive aspects, and it's really just about finding the fitness for purpose, and sometimes just the practicalities of what can you fit into a personal pension and what can you not. You can't put a community share, for example, into a personal pension because of its structure. You can't put an industrial providence society, a Conven type organization, into a pension because of its structure. So there are issues around, you know, the practicalities, and that's the planning bit of what we do in terms of helping people on that journey. But it's, you know, it's exciting times because there's a lot more choice, and the web gives you access to it all and such like.
Yeah, no, thank you. And I suppose, you know, in terms of when people are thinking about, you know, maybe a sector-based approach where they might say specific areas that they want to invest in. Francesca, I don't know if you're seeing out there in terms of what people are interested in investing into.
Yeah, I mean, it really depends, and you know, you've got a whole spectrum of different approaches. But if you look at it from a kind of financial return perspective, you've got things like someone's talked about ESG ETFs, for example, which are kind of much more on the traditional returns. And then all the way on the other hand, you've got things like Kiva, for example, where you're just lending and you're just getting your money back and you're not getting anything else above that. So there's just so many different approaches. But I think the ones that have really kicked off recently are the thematic ETFs, I think. So things around clean energy, clean tech, really popular, also clean water. Josh Gregory mentioned some of the recent ones that have been launched, like around agriculture. There's a new RISE, Sustainable Agriculture Fund. There's things around circular economy. But I would say most of the people looking to have an impact on the environment will probably look at some thematic ETFs, of which most are clean water, clean tech, and yeah, probably those two. But again, like Josh Brewer, you were saying, it's probably not going to form a huge amount of your money. Like it might be up to 5% of your total investment. So there's a concentration risk there often, especially with the clean energy ones. A little bit less on the social side. They tend to be a bit more less concentration risk, because what you're doing is you're looking at companies that are managing themselves in a kind of socially responsible way. And so you have many different sectors with that. That's a bit of a rambling answer. There's just lots of different options.
No, I mean, I think that chimes quite well with what we see on ethics. We see a lot of demand for community-owned renewables, for instance. We're seeing an increasing demand around sustainable transport and particularly EV charging infrastructure and EVs more generally. Housing is a really interesting one. Affordable housing and supported housing are very, very popular areas. And certainly organisations that are tackling homelessness fill offers pretty quickly on ethics, actually. So there is this kind of range out there. There's a couple of interesting questions that, Josh, if I just turn to you a sec. So there's a couple of interesting questions that have come in, which I think maybe Sugi can help answer, is people have said they've looked at ESG funds, and when they look underneath the bonnet, they're basically investing in big tech companies often, and they can have quite high power usage, for example. So how can an investor be able to kind of do a bit more of a thorough check on a fund?
It's an interesting point around tech. So yeah, a lot of people, if you look at some of these ESG indices, they do tend to concentrate on tech companies, and actually tech has a much lower impact overall than most of the other sectors. So like pound for pound investing in tech has 36 times less of a carbon impact, at the very least, of investing in utilities. And then energy, for example, has even 8 times more impact than investing in utilities. So there's a difference of around 280, I think, times between those two sectors, just to give you an idea of the range. And the question is, but tech uses a lot of power, right? But they don't have huge supply chains, which is where it comes in. So manufacturing, industrials, at each stage of the process, there's a huge amount of power going in to, generate, raw materials, or turn raw materials into products, or to ship stuff to consumers. Yeah, tech, they have basically these huge server farms, but they don't have any cost of shipping to consumers, essentially, because it's done quite often now electronically. The days of getting like a CD in a box and things like that have basically passed. So that's the reason why. And a lot of tech companies have now actually transformed their power usage to renewable energy. So they're actually, their carbon footprint of their so-called scope, I think it's scope 2 emissions, is essentially much lower than if they were, say, next to a coal plant or something. But yeah, I think it is really interesting to look at the different sectors. And, if you want to just have a really low impact portfolio, by all means, invest in tech, financials, healthcare. But yeah, I mean, that's probably not the advice a responsible advisor would give you, just to have that level of diversification. And I think, and Francesca also touched on it, there are a lot of companies which are in other sectors with higher impact, which you may want to look at. And there's generally 2 reasons why that might be. The first is that they are best in class, so they may have a high impact, but they're reducing their intensity, and they're leading their peers, showing the way it's done. And we need to support these companies, because actually the higher impact companies are the important ones to support during the transition. And there are also companies that may have a higher impact themselves, but are helping the climate change fight in other ways. So, they're constructing electrified transport systems for cities, or they're creating, insulation for homes, so our heating bills go down. And so it's not quite as cut and dried as basically saying just invest in low carbon sectors. But it is quite hard to identify those particular companies, which is where you may want to look at a thematic, or you may want to go to an active, a manager who has expertise in selecting those type of companies.
And there are useful, there are organisations that kind of review and rate some of the funds out there. So one of the ones I know is called 3D Investing, and they actually apply, a star score to various funds from 1 through to 5, and to give you an idea of just how green an investment actually is. So there are some of these sort of tools out there and guides out there. Ethical Consumer is another one that produces quite a lot of information on good fund guides as well. I suppose one of the other questions that's come up, and it hasn't come up in the chat, but it does sometimes come up, is that this idea that it's inherently more risky investing into investing in a positive way, or and it's also that you get a lower return. Julian, I'll let you speak to the risk issue. Just in terms of the return, I think at Ethics and Energise Africa, what we say is that we think investors should be able to get a fair return. So that's often around about between in a range of 2 to 5%. And we feel that that's giving investors a reasonable return on their investment, a fair return, but also enabling them to deliver that impact as well. But I'll be interested on your take on both of those points, actually. One about sacrificing returns and one about overall risk.
Yeah, I mean, I think the risk issue was historically the sort of FOMO issue, the fear of missing out. That if you're not invested in those oil companies and armaments companies, then you won't get the profit when when there's a war going off, or when we desperately need to pump oil or something like that. So there was always that aspect, and I think historically there's a raft of academic research that's been carried out, and I could quote any number that have shown that over a period of time. And bear in mind that for most people, apart from your cash deposits, etc., investing is a long-term activity. It's a 5, 10, 15-year investment strategy. Over the longer term, you will probably achieve similar, if not better. In the last 5 years, we'd argue certainly better. There's been a real uptick in interest in the sector and more opportunities because whereas historically you'd be investing in just what was in the market, and there wasn't perhaps that much innovation historically in equity markets, but now we're seeing money flowing into climate solutions and clean water policies and health and safety and PPE and health and education, transport, etc. So we're seeing all those things develop, and those are growth areas, those kind of industries of the future, and they're quite often heavily or more heavily weighted particularly in a thematic or climate based investment portfolio that is oriented to trying to get those solutions. So I think the risk, risk is more about how you construct an investment portfolio. It's what the mix of the different assets are. They're the real component parts of whether it's a risky portfolio or not. If you're all invested in a 100% growth equity fund, then it will be risky. If you are equally, if you're invested in a startup project which is needing early funding, and you'll know this, Josh, from just the pricing of bonds and things that are available in terms of things. If you're investing in a feasibility study on a wind farm on a site, then which you do see sometimes the bonds arriving there, that's a lot more expensive than when it's up and running and generating revenue and such like. Yeah. So rate is a great guide to risk, in terms of that. Yeah, and fair rates of return. What's your benchmark? Ideally, your benchmark is inflation. If you're investing for a return, are you making more than the rate of inflation over a longer period of time? Yeah. And anything over and above that is then giving you what we in economic terms call real return. It's making a profit. So that's your benchmark.
Okay. Yeah. Thanks, Julian. That's really useful.
Can I just add something to that point?
Yeah, please do.
I think the point about risk and return is really interesting. I think, if you look at the last 5 years, you look at the S&P 500, the kind of ESG ETFs have outperformed slightly. I would say more and more people, when I come into corporates, some of them are interested from the impact perspective, and they say, we're looking to have an impact with our money. Can you come and chat to us? Other people are looking to make more money. They're like, I've heard it's really profitable. I think I want to get into it. Can you tell us about it? And I would say, I'm not sure about that approach. I think if you're looking to just make as much money as possible, I'm not sure I would go down the kind of ethical, sustainable ESG route. I think I would just kind of stick with the traditional investments, because actually the point of the ESG and the impact space is that, you are looking at the impact. That's just something I wanted to mention. Also, around the returns, what tends to happen is that maybe these types of investments don't return less, but sometimes the fees are a little bit higher, and over time they add up, and that's something which I've got my money invested in that way, and I'm okay. I've looked at the fees and I'm comfortable with them. But often those, even the passively managed funds, sometimes they will have slightly higher fees, and for the actively managed fund, because they're putting that work into the engagement often as well. So that's just something to look out for if anyone on this call today is looking at a specific fund. On the ESG side, the returns might not change that much, but sometimes it's just the fees just to look out for.
Yeah.
Makes sense. I mean, you're paying a little bit more, you're getting a little bit more work as well.
Exactly. It's that you've got somebody actively managing that. I just want to come to a point that someone raised right at the beginning, actually, when we talk about, ESG and impact investing. Is there a risk of it turning into a bubble? In the same way that we saw a dot-com bubble in the end of the 1990s?
I think, I think there's two things. One is, and the regulator, the Financial Conduct Authority, has recognised that is that there is a risk of consumer detriment. There is a risk of a lot of people rushing to the market with the investments which don't really meet what the consumer is expecting to be, and therefore they're starting to take steps to do that. The impact issue, I think, is an area. So, going back to the earlier point about, where do you invest and why do you invest? We always say about diversification. I mean, it's very interesting to have a focus on a particular area. And it's sometimes, again, if you're really interested in renewables or whatever, perhaps it's better to go and focus that money into an FX community wind farm, project or something like that, rather than just trying to invest in a clean energy fund or something like that, which probably isn't giving you the direction that you probably expect. You're probably investing in meters and data processing more than anything else. Yeah. I think that there is a risk potentially of a lot of money chasing the same funds, the same companies, because it's become a kind of flavor of the day and a bubble in terms of that in the equity markets. But it all depends on how you define impact, I think.
Okay, yeah, thank you. And I'm just going to come on. So we are, there is a development of kind of investment platforms, and I suppose the question is, what can they do and what are they doing around driving transparency around the impacts and how it can be improved to prevent greenwashing? And if Josh, if I'll put that one through to you.
Sure. So I think, sorry, there's a bit of an echo. I think there was a point we made earlier around the difference between voluntary work and regulation. I think in this space, we really have to rely on regulation. At the moment, there's a broad variety of standards. Obviously, there's a large variety of ESG ratings as well, which aren't particularly consumer friendly. So, for example, if you've got like 0 to 5 stars, what does that mean? Does it wrap up a load of different factors? How many factors? Like sometimes it's like 150 to 200 factors within one. So I think what ideally what we'd like to see is more kind of more transparency from the platforms into the underlying data, so that the consumers can make their own minds up, rather than aggregating things into slightly bad, possibly difficult to understand metrics. And at the same time, yes, I think what we've seen in Europe with the sustainable finance disclosure regime, there's a taxonomy, which means that essentially there are only a certain number of activities that can be called green by law, and investments which cover those particular activities can be called green. And it's very cut and dry between the two. And I know the government is looking into creating one of those taxonomies in this country in the next year or two. And also the FCA is looking at creating something called a sustainability stamp, which essentially is, yes, another one of these kind of aggregated metric type things. And it is a little bit worrying, considering, to my mind at least, that hasn't really worked. Although, arguably, if you look at the space of, say, commodities, having like certification like fair trade, Rainforest Alliance, any kind of stamp of approval, people don't actually need to necessarily go further than that, as long as it's a trusted stamp. So perhaps the FCA stamp will be really useful in that respect. But we've got a long way to go, I guess. Yeah.
No, thanks, Josh. I'm conscious of time, so we've just got 5 minutes left. So we've actually ripped through that today, which is great. So it's been a really good discussion. So I'd just like to finish off, I suppose, for if you're talking to someone who's just coming to this and they want to know, what are the top tips for getting started, and what would be your couple of key pointers to someone to get started? Julian, can I start with you on that one?
Yeah, I think I'd probably just ask yourself 3 questions: why, when, and where. Why are you investing? What's your objective? What are you doing with your money? Is it a short-term objective? You've got something you need to buy in a few months, a few years' time or something. Is it for the longer term, etc.? When do you need access? So it's kind of linked into that again. When do you need that money back? Because that will influence the vehicles you might use, whether it's cash or a short, medium-term investment, or a kind of long-term 20-year bonds to support some a long-term project. And then where is well, what am I trying to achieve with my money? And be idealistic, but be pragmatic as well. Be kind of real, think about spread and what's important to you and what you can live with. So maybe there's a bit of a balance in terms of your investment approach about where money goes. As you say, there's various resources which you can use to have a look at that. A metric you're seeing used an awful lot these days to communicate what investment funds do is the UN Sustainable Development Goals. They're useful, but again, open to wide range of interpretation and arguably misrepresentation. So we talk about greenwashing, we talk about rainbow washing as well. Anyway, those are some ideas I'd be putting out there.
Yeah, thanks, Jude. Francesca, what would your advice be?
Yeah, it's a great question. I mean, in this 45 minutes, we've talked about banks, pension funds, actively managed funds, passively managed funds, community shares, innovative finance ISAs like mini bonds. So stuff we haven't talked about as well, the SEIS investments that you can make. I mean, there's just so many options available for people, and I think start somewhere. So maybe start really small. So there are like the platforms I've seen in the chat, someone mentioned the Big Exchange. They have I think a really good offering, and there's Climate Invest, and there's Circa 5000. There's some of these platforms as well. You can do like £5 or £10 and then just sit there and get to know a little bit what's in the portfolio. It can be quite overwhelming, and so I think start small and just start somewhere, and then you'll learn as you go. And people like Julian are obviously there for you if you're looking to take a little bit more seriously. And I think that's also a great option to get a financial advisor that can help with this. The other thing I really want to mention is that there are lots of problems with this space. There's lots of lack of clarity, and there's not much regulation, and there's lots of fears about it being a bubble and things like that. I mean, people on this webinar today are the sort of early adopters of this space, right? And you're kind of crafting the way. So the questions that you're asking, the way that you're investing, the fact that you're here today, I mean, it really means it sounds really cheesy, but we are kind of changing the world through this stuff. And it is a bit annoying and it is a bit difficult. It's because we're some of the first people to do that. Julian, I know you've been in the space for 20 years. There's a lot of people, I mean, still in the grand scheme of things, there's actually still quite a short space of time. And, in 10 years or 20 years time, there'll be lots more clarity on all of this. But don't get disheartened and think, oh, well, it's not as transparent as I'd like. So let me just, not do anything. Like, this stuff does matter. And we're all just in the really early stages of this growing market. So kind of bear that in mind if you're going through this journey. You will get,
Francesca.
It does make a difference.
Josh, if you could just finish off there.
Yeah, I really can't top that inspiring intervention by Francesca, so I'll keep it really brief. If you're interested in, if you've got an investment a portfolio and a common investment platform, use our app to check how green it is, and be aware as well, which I wanted to mention earlier on, that you may end up having to do some trade-offs, and it's not necessarily around return, but given you just need to make sure that what your priorities are, and ensure that you're investing just be aware that your investments may have some kind of trade-off. So, for example, if you're investing in purely low carbon, you may not have the best water impact or the best biodiversity impact, and just recognise that that's just, that will be the case. So don't let the perfect be the enemy of the good, I guess, would be the sort of follow-up point to that.
Yeah. No, thank you, and thank you to all the panel for that, and to everyone that's joined us today. I guess I might just finish off on that, and that do dip your toe in, come and take a look at the various places that are out there. Big issue exchange, I think, is a good place to start. But also take a look at the FX platform, take a look at Energise Africa, but do bear in mind that this should be a small part of overall what your investment might look like. But I guess just want to finish up and say that to back up what Francesca said, we do stand on the cusp of enormous change, and it's essential, if we want to preserve the world that we have, that we make those changes, that money is put into climate change mitigation, for example. And I think it's important to remember that if you look throughout history, finance has been a driver of transition. So, you as an individual can make a huge change by the way in which you use your money. So please bear that in mind. Okay, just like to say thank you again to everyone for joining us today. Thank you to the panel, Francesca, Josh, Julian. Thank you to Ethical Consumer for hosting the webinar. Take care, everyone, and goodbye.
Thanks, Josh.